Hey everyone. Big news from Washington. The Federal Reserve has just made a major move by cutting interest rates for the first time since the early days of the COVID pandemic. They've slashed the benchmark rates by 0.5 percentage point to help prevent a slowdown in the labor market. With both job growth and inflation cooling down, the Fed's Federal Open Market Committee decided to lower the key overnight borrowing rate by 50 basis points. This move was widely expected by the market, which had recently shifted its outlook from a smaller cut. This significant cut brings the federal funds rate down to a range of 4.75% to 5%. While this rate primarily affects short-term borrowing costs for banks, it also impacts consumer products like mortgages, auto loans, and credit cards. But that's not all. The committee's plot suggests we might see another 50 basis points of cuts by the end of the year, aligning closely with market expectations. By the end of 2025, we could see a full percentage point in cuts, and another half point by 2026. Overall, the benchmark rate is projected to drop by about 2 percentage points beyond this latest move. In their post-meeting statement, the committee expressed confidence that inflation is moving sustainably toward their 2% target and that the risks to achieving their employment and inflation goals are balanced. The decision to ease rates was made in light of progress on inflation and the balance of risks. Interestingly, the vote was 11-1, with Governor Michelle Bowman preferring a smaller quarter-point cut. This dissent was notable as it was the first by a Fed governor since 2005. Fed Chair Jerome Powell emphasized their commitment to restoring price stability without causing a painful increase in unemployment. He stated, "We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with this inflation." The market reacted with volatility, with the Dow Jones Industrial Average initially jumping 375 points before settling down as investors digested the news. Stocks ended slightly lower, while Treasury yields bounced higher. Economist Tom Porcelli noted that this isn't the start of a series of 50 basis point cuts, but rather a recalibration of policy in response to slowing inflation. The committee also noted that job gains have slowed, and the unemployment rate has ticked up but remains low. They adjusted their unemployment rate projection for this year to 4.4% and lowered the inflation outlook to 2.3%. Despite solid economic indicators like steady GDP growth and strong consumer spending, the Fed chose to cut rates even though inflation remains above their 2% target. Powell and other policymakers have expressed concerns about the labor market, with hiring slowing significantly. This move helps settle the debate over how aggressive the Fed should be with rate cuts but raises questions about future actions. Investors have been uncertain about the move, with odds shifting to a half-point cut just before the decision. The Fed last reduced rates in March 2020 as part of an emergency response to the COVID-19 economic shutdown. They began hiking rates in March 2022 to combat rising inflation and last raised rates in July 2023. With the Fed at the center of the global financial universe, this decision will likely influence other central banks, many of which have already started cutting rates.